Chairman of the Stock Exchange of Thailand, Secretary General of the Thai SEC, President of the Stock Exchange of Thailand, Chairman of Pipat Securities, ladies and gentlemen, a very good morning to you all. I would like to thank the Stock Exchange of Thailand, Pipat Securities, and Bank of America Merrill Lynch for the invitation to join this year's Thailand Focus event. I am much honored to be addressing this prestigious group of audience, and especially investor friends of Thailand from abroad. The title of my talk this morning is Monetary Policy and Financial Sector Development Policy of the Bank of Thailand. I would like to share with you the Bank of Thailand's roles in supporting the Thai economy as we venture ahead in the volatile world. This year, there would be few among us who fail to notice turbulence in financial markets worldwide. But what probably matters more is the shifting global economic forces that lie at the heart of such an incident. In the first part of my talk, I will explore volatility in the context of a new normal world, where we observe, for instance, stagnant growth and low inflation. Then I will discuss implications for Thailand before moving on to policy navigation of the Bank of Thailand. Financial volatility has manifested itself throughout 2015. Let me briefly recap some of them. Only a few months ago, I'm sure we all remember, the Chinese equity market recorded one-day steepest loss of 8.5%, and trillions of dollars were wiped off from the global equity market within a day. The fluctuations in the Shanghai Stock Index perfectly exemplifies the market volatility, where from the beginning of this year, the index rose by 60% up to June, before collapsing to 10% loss by August. There have also been sharp capital outflows from emerging markets, resulting in large emerging market currency depreciations. Indeed, the Institute of International Finance expects capital flows to emerging markets will turn negative for the first time since 1988. On the commodity front, Brent crude oil price plunged below $50 per barrel this year, having peaked at over $110 just 1 year ago. Against this backdrop, market participants have been increasingly concerned about investment and business implications. So what brought about heightened volatility in the global markets? I will attempt to answer by highlighting two key sources of volatility. In the aftermath of the global financial crisis, unconventional monetary policies, most notably successive rounds of quantitative easing, were implemented by major advanced economies. This abundant global liquidity contributed largely to strong asset price gains and higher risk appetites. As major central banks pursue its policies of flooding the market with liquidity, risks had been compressed intentionally or otherwise. Recently, though, despite ample global liquidity, investors have grown worried about the diverging paths of monetary policies among major central banks. That is, the Federal Reserve is poised to begin its tightening phase, while the European Central Bank, the Bank of Japan, and the People's Bank of China are likely to continue their ongoing monetary easing for a considerable period of time. The implications of diverging monetary policy stance for asset markets have weighed on the minds of the investors around the world. As I shall elaborate, it is probably not the excess liquidity per se that generates turbulence and volatility, but prospects of the exit or reversals that does so. In the near future, global markets are bracing for the impacts from the Fed lift-off, leading to growing nervousness in the markets. Although the prospect of an interest rate increase by the Fed has been widely anticipated ever since the taper tantrum in 2013, the uncertainty over its timing and possible impacts has in part contributed to episodes of market turbulence this year. After the eventual lift-off, whenever that may be, the markets will turn their attention to the pace of monetary tightening or rate increases. The shift in market expectation over the pace will prompt volatility going forward. Hopefully, I have not spoiled your morning by delving too deeply into volatilities. But let me stress this. Monetary policy's divergence will continue to be an underlying source of volatility in the global and regional financial markets. However, issues in financial markets are by no means disconnected from the real economy. Indeed, volatility arises from slow recovery and timid growth outlook for the global economy, the so-called new normal. Looking ahead, the global economy is expected to grow only at a subdued pace as some major advanced economies are still grappling with the impacts of the global financial crisis, and emerging markets are faced with sluggish exports. Many economists have begun to refer to these conditions as a new normal for the global economy, where global growth is weak, global merchandise trade shrinks, and commodity prices remain low. An important factor behind these global dynamics may be attributed to China's attempt to rebalance its economy with more emphasis on domestic consumption and less on investment and exports. While China is undergoing its economic transition, a slowdown in its growth rate is inevitable. The repercussions of China's transitions have been quite evident on the collapse of commodity prices, leaving many emerging market commodity exporters with current account deficits and sharp currency depreciations. Another crucial driver is the trend of onshoring among major economies, leading to a structural change in the global supply chain, where countries like the US and China seek to source inputs domestically rather than imports of intermediate goods from other countries. Thus, even if global growth were to be robust, it is unlikely that emerging market export growth would recover quite as strongly. I would certainly be remiss if I failed to mention another potential risk in emerging markets which could have impact on the real economy. That is a rapid build-up in emerging market corporate indebtedness. Ultra-loose global monetary policies have made it much easier for firms in emerging markets to raise funds or borrow, especially from abroad. However, in the wake of tighter financial conditions, emerging market firms are facing greater difficulty to repay or roll over that debt. In summary, I have highlighted two key sources of volatilities. First, continued excess liquidity amid diverging monetary policies, along with shifting market expectations about the future path of monetary policies. And second, the global economic transition to the new normal steady state. The process is ongoing and will probably take some time, and it may not be smooth before the new steady state is reached. Ladies and gentlemen, against the backdrop of such a volatile new normal world, I will now turn to implications for Thailand. The impact will be realized on both our financial markets and the real economy. However, as I shall elaborate, the Thai economy has strong buffers that will make it relatively resilient to external shocks. Let me start by looking at implications for the financial markets and the exchange rate. In line with the trend of regional currencies, the baht's recent movement has been largely influenced by external factors. Any imminent signals of the Fed's initial hikes or worse than expected data coming out of China would prompt capital outflows from emerging markets, thereby weighing down their currency values. Significant outflows could tighten financing conditions of domestic companies in terms of both cost of funds and availability of funds. Such interplay of several risk factors is a challenge for business managers and investors alike. However, international investors, like many of you here, have been increasingly selective in your portfolio decision. International investors no longer treat emerging markets collectively as a single asset class, but have shown to differentiate between emerging markets. As such, even though emerging markets may generally move in the same direction, the actual adjustments across individual markets have been uneven. In this context, the degree of the Thai baht depreciation ranks within the middle of the regional movements, and our currency is also closely taxed regional peers, while the level of its volatility is moderate relative to peers. This owes much to Thailand's sound external position, which provides cushions from volatility in the global financial markets, shielding the economy from any potential undesirables. An economy with strong buffers could be likened to a car with good suspension, which could smoothly go through a bumpy road of global financial markets volatility. In fact, on the external stability front, Thailand performs well across several metrics. The current account surplus is expected to top 6% of GDP this year, amounting to more than $26 billion. As the minister pointed out, public debt stays rather stable at around 40% of GDP. Our international reserves stand at almost 3 times of short-term debt, among the highest in the region. The non-resident security holdings in our bond market is lower than 10%, while those in the stock exchange of Thailand account for around 30% of market capitalization. Such relatively low levels of non-resident participation compared to our peers suggest limited exposure to future capital flight. Corporate sector's foreign debt also accounts for just 13% of total corporate debt as of mid-2015. Moreover, most external debt is concentrated among large corporations. These large firms tend to manage the exchange rate exposure well by utilizing financial hedging instruments. Careful risk management practice among Thai corporate and financial institutions has made them much more resilient to volatile movements of the exchange rate. The Thai banking system is also resilient, with a high level of capital buffer and stable loan growth, despite some deterioration in loan quality. Banks have closely monitored their customers and maintain a high level of loan loss provision as a buffer of bad loans. They are also well capitalized, with the capital adequacy ratio at 17.3% and Tier 1 ratio at 14.4%, among the highest in Asia. This suggests that our banking system has sufficient capital to shoulder unexpected loss and accommodate credit expansion. In addition, their profitability will help enhance their capital base over time. Last but not least, inflationary pressure is stable due to a substantial fall in oil price from last year. Headline inflation, though currently in negative territory, is expected to gradually rise and turn positive in 2016. Deflationary risks remain contained as demand continues to expand, and prices of most non-energy items remain stable or trend upwards. Such inflation trajectory is consistent with medium-term expectations of the public and the Bank of Thailand's medium-term inflation target. Overall, the economy and our financial system show a good sign of stability and resiliency. Let me now turn to implications for the real economy and begin by giving you some positive news. That is, the economy is likely to register stronger growth momentum next year. Tourism continues to show good prospects, where the number of tourist arrivals is likely to exceed 30 million in 2016. Fiscal stimulus will continue to be a key growth driver. Public expenditure is expected to increase by more than 200 billion baht from this year, providing support to the economic recovery, especially the construction sector. In the private sector, there are signs of investment expansion in construction, telecommunications, and alternative energy, among others. Although we may see export contraction in 2015, there are resilient spots in certain sectors. Exports to the CLMV countries have experienced strong growth and continue to show great potentials from which Thailand could capitalize. In fact, the share of exports to CLMV in our total exports is now on par with the shares of our exports to the major trading partners, such as the US, Europe, and Japan. Thailand's exports to the US are also poised to become firmer as the US economy continues to see improvement in its recovery. Our exports of vehicle parts, electronic appliances parts, and electronics to the US have expanded in the past few months and are likely to continue their growth momentum in 2016, in line with the US economic recovery. Nevertheless, structural limitations still weigh on long-term growth. The recovery of the export sector will continue to be impeded by a shift in the global trade structure. Some of our products, such as apparels and garments, have seen a continuing decline in competitiveness, while some others are falling out of technology trend. Simply put, the Thai economy is like a car whose engine is in need of an overhaul. We need structural adjustments in growth drivers to enhance our competitiveness and sustainable economic growth. The private sector needs to invest in new production technology and improve product quality in response to changes in global demand and consumer preferences. As Mohammad El-Arian, then the CEO of PIMCO, once said, structural challenges require structural responses. In this context, we welcome many initiatives by the government to stimulate public and private investments and upgrade Thailand's value chain. With the introduction of changes in the Board of Investments criteria for investment privileges, the government has geared up its effort in promoting high value-added industries. It also announced special economic zones in order to facilitate the growing networks of production, trade, and services, initially with our neighboring countries. By expediting growth-enhancing infrastructure development and increasing ease of doing business, the government also helps promote crowding in of private investment. Fiscal reforms are also in the pipeline in order to boost efficiency of the public spending, revenue collection, and other public administration. Reform of state-owned enterprises, which you will hear more about tomorrow, will also be vital to upgrading the country's growth potential as they manage strategic assets of the country and account for a large share of public capital expenditure. All in all, our car needs an engine overhaul. The government's recent initiatives form an important part to uplift the car's engine. In the meantime, I can assure you that we have a good suspension system to get through a bumpy road of market volatility ahead. Ladies and gentlemen, at this juncture, during which Thailand is going through multi-dimensional reforms, the Bank of Thailand will do our part to safeguard stability, support economic recovery, and facilitate long-term structural reforms. There are three main elements of our policy navigation that I would like to share with you this morning. First, the Bank of Thailand will ensure ample liquidity in the system in order to accommodate the economic recovery. As policy normalization by the Fed is imminent, the risk of liquidity withdrawal from emerging market increases. We anticipate limited impact on the overall Thai economy as markets have already priced in the Fed's initial rate hike. Besides, it is widely expected that the Fed fund rates would rise gradually from then on. As for now, despite the slow economic growth in Thailand, the overall bank credit to the private sector continues to expand at around 5%. Furthermore, enterprises have issued a sizable amount of corporate bonds, leveraging on lower yields compared to last year. Commercial banks' liquidity position is stable. All these are indications of favorable domestic financing conditions. Should a sudden reversal scenario occur, the Bank of Thailand would make sure that liquidity will not become an impediment to economic recovery. The Bank of Thailand will also ensure that cost of funds is accommodative to the ongoing recovery. The two preemptive cuts in policy rate earlier this year, in response of greater downside risks to growth, had eased domestic cost of funds. In addition, low inflationary pressure gives room for monetary policy to remain accommodative. This would ensure that the overall monetary conditions are conducive to the economic recovery. Nevertheless, we keep a cautious eye on risks to financial stability, especially under the prolonged low interest rate environment. Household debt, although it has stabilized, remains high in relation to GDP. We will continue to monitor and assess the impact of interest rate on the search for yield and long-term saving behavior. We are also vigilant of other pockets of risks which may have destabilizing effects on the economy, such as those in the real estate sector. Let me now turn to the Bank of Thailand's plan to handle increased volatility of foreign exchange, which is the second element of our policy navigation. As a matter of fact, a certain degree of foreign exchange flexibility is desirable for the economy, as it allows foreign exchange to act as a shock absorber and facilitates real economic adjustments. With weaker outlook of growth across emerging market economies and expected Fed's policy rate hike, many emerging market currencies, including the Thai baht, have depreciated. In case of Thailand, with relatively strong external financial positions and well-managed foreign exchange risk exposure by public and private sectors alike, the risks from substantial foreign exchange debt exposure are currently contained. In addition, as part of the capital account liberalization master plan, the Bank of Thailand announced earlier this year the relaxations of capital flows measures in a bid to promote more balanced fund flows and greater flexibility in the foreign exchange markets. As the global financial market will continue to be volatile in the near term, the Bank of Thailand thus remains focused on mitigating short-term excessive exchange rate volatility to cushion any impact it would have on the domestic financial conditions and consequently the real economy. In the longer term, however, demand management macroeconomic policies, be it fiscal or monetary, cannot be used to address structural problems successfully. As such, the Bank of Thailand is also geared towards financial sector development in order to facilitate the country's long-term structural reforms. Financial sector development is the third element of our policy navigation. The Financial Sector Master Plan Phase 3 will aim for a competitive, inclusive, connected, and sustainable financial sector. Our vision is to have a competitive Thai financial sector which can support more diverse needs at a fair and undistorted price, promote regional trades and investments while maintaining safety and soundness of the economy and the financial system. Today, I hope to share with you some of the highlights and key milestones. 5 years from now, I foresee that the Thai financial landscape will look different from today, with more digital banking and electronic payment transactions, and increased competition from non-banks and foreign players. The landscape will also contain innovative fintech companies who provide alternative solutions to both service providers and users, such as data analytics, crowdfunding, and product or price comparison services. Ultimately, Competition will increase financial access and lower transaction costs to the economy as a whole. The Bank of Thailand will focus on the development of infrastructures and standards, while ensuring that rules and regulations are clear and supportive of innovation and efficiency. The new Payment System Act will unify all relevant regulations currently specified under different laws and enforced by various different agencies. In addition, the Bank of Thailand will support the government's initiatives to promote nationwide electronic payment system, including, for instance, the development of any ID payment infrastructure and the promotion of debit card usage for payment and transfer of welfare benefits. On connectivity, the establishment of qualified ASEAN banks or QABs will allow Thai banks to expand regionally while welcoming foreign banks in the region to conduct businesses in Thailand. Bilateral negotiations with several countries have been planned, and I expect some arrangements to be made by the end of next year. The Bank of Thailand will also collaborate with other central banks in the region on the promotion of local currency settlements for trades and investments. The appointment of cross-currency dealers to act as clearing agents for Baht and Malaysian Ringgit should be done by the first quarter of next year, while negotiations with other countries are ongoing. We are conscious of the rules and regulations which may hinder the development of regional trades and investments, and we are working carefully to remove obstacles without compromising stability objective. The joint initiatives by the government and the Bank of Thailand regarding treasury centers have generated interest among large companies applying for a license. These treasury centers can purchase or sell foreign currencies and hedging instruments for companies within their groups, thereby aiding in foreign exchange and liquidity risk management. Multinational companies, as well as large Thai corporations with overseas branches, could similarly benefit from lower transaction costs and improved liquidity management. On top of the tax incentives offered by the Board of Investment, international headquarters established in Thailand will be eligible to provide financial management services to companies within the group once granted the Treasury Center license. Rules and regulations also need to keep up with innovations in order to ensure safety and reliability of the financial system and to maintain confidence of the public. To this end, the Bank of Thailand has been given a full responsibility in the regulation and supervision of the specialized financial institutions, or the so-called SFIs, which amount for more than 20% of Thai financial institutions' assets. In performing such roles, the Bank of Thailand will apply the internationally accepted principles and standards, taking into account the mission, mandate, and current conditions of each SFI. The ultimate goal is to ensure safety, sustainability, and soundness of SFI's operations so that they can perform their core duties for the long-term benefits of the Thai society. Ladies and gentlemen, it is clear that the world is currently changing fast. The global economy has now entered the new normal environment. Indeed, we expect to experience greater volatility as the world is in transition to a new steady state. Looking ahead, we must not fear volatility, but be mindful of associated risks and ways to manage them. So far, with robust cushions, Thailand has fared well from external shocks compared to other emerging market economies. This does not mean that we can be complacent. Our country is in need of reforms to address long-term structural problems, similar to having a more powerful engine, enabling us to reach our destination faster. Fortunately, though, our economy is currently equipped with strong buffers, similar to a robust suspension system in a car, smoothing our ride through bumpy roads. Ladies and gentlemen, let me assure you that the Bank of Thailand will do our part to ensure a stable and resilient macroeconomic landscape. We will accommodate changes, especially those in the financial system, which will put Thailand on a stronger footing and in a more competitive position. I am confident that Thailand will ride forward with a much more powerful engine it deserves. Thank you very much for your attention.
So thank you very much, Dr. Veerathai, for a very insightful speech. We are very glad and honored to have you here with us today. I'd like to gain your perspective on a few more issues as we move into this interesting time, both for the economy and also the central banking in general. First, let me start with the easy one, because you mentioned already about the changing landscape for the financial sector, and in particular the e-payment system that I guess the minister has mentioned also this morning. And 2 days ago, you announced this new national e-payment. Can you elaborate a bit more about this plan and what can we expect in terms of the changes going forward?
National e-payment system is an initiative pioneered by the Minister of Finance himself. I think this is something that can change the landscape for financial system in Thailand. At the Bank of Thailand, we have had successive rounds of payment development plans. In the past, we tend to focus more on large value payment system to ensure that we have a stable, efficient, large value payment systems. And we're entering a new phase where we should develop retail payment system to promote financial access for the public at large, with a more effective engines and also at a very reasonable prices. There are quite a number of initiatives that have been proposed by the working team of the Ministry of Finance, of which the Bank of Thailand is a joint secretariat. Two initiatives are involved with setting up a new payment infrastructure for the public at large. One is any ID, the so-called any ID payment infrastructure, in which now if you look at the current payment infrastructure, it's like a bowl of spaghetti lines. There are quite a number, depending on the products, the types of financial products, like ATM transaction go through one switcher, credit cards go to another switcher, internet payments through internet banking goes through another switcher. And that has created rigidity in system development. With any ID infrastructure, it will provide a central switcher whereby switching can be easily done across different products. And it will also be much easier for the public at large, because you can link your account with the national ID number or telephone number. Okay? And this can also be linked with e-wallets and also a mobile payment infrastructure that a number of mobile phones companies are developing. So that's any ID infrastructure. The other one is on the usage of debit card, the promotions of debit card usage. Thailand is still very much cash-based society. And as we all know, it's very high cost for the banks and also for the businesses at large. By promoting debit card usage, that will help lower transaction costs, and will also help improve governance and transparency on financial transactions. The Bank of Thailand has been working with commercial banks for quite some time now in upgrading the debit card infrastructure. We have already agreed on the plan to launch the chip-based card, chip and pin-based card by the middle of next year. And with the initiatives of the Ministry of Finance, we try to also to expand the point of sales machines all over the countries, and that will also be linked with tax collection, and that will improve transparencies and governance in tax administration. There are also a number of other initiatives that the government is pushing forward on e-payment. One is on government e-payment, whereby all the government agencies receiving payments and also making payments will be required to execute those payments through electronic channels. Tax collection and also not just only the money transfer, but the documents that have been cumbersome for all businesses could be done electronically. Okay, so those are some of the major initiatives in place.
I think the goal is to make the payment system more efficient and reduce the cost.
Definitely, and also provide, it's a part of financial inclusion.
Okay. Yeah. Thank you. Next is about the policy divergence. I think you also mentioned that the monetary policy divergence would be the source of volatility going into 2016, and I think many of us here take that as a key themes going to 2016 as well. How do you assess the impact of policy divergence, in particular on the Thai economy, and how is monetary policy prepared to cope with those volatility, especially on the exchange rate front? And on that regard, are you concerned by the notion of currency war or the competitive devaluation in the world where the economic recovery is uneven?
There are quite a number of dimensions in your questions. Let me try to answer one by one. On policy divergence, one good thing is that the financial market has well anticipated such a policy divergence for quite some time. If you look at what happened during the past 2 weeks or so, when the non-farm payroll coming out from the US exceeded market expectations, that did not result in any market disruptions. So it shows that the markets have well anticipated the Fed lift off. We should also be mindful that it's not the timing of the Fed rate hike that matters. It's also the pace of the interest rate hike that will probably matter more next year. Fortunately, the Fed has been giving quite a clear signal that the path will be quite gradual over time. And they're also concerned with the pace of US dollars appreciation if such a pace of interest rate increase were to occur faster. Definitely, we'll see adjustment in exchange rate of major currencies. The ECB, Bank of Japan, and now we see the People's Bank of China are willing to be more accommodative. Okay? But overall, I think if you look at the overall liquidity that will be out there in the global financial market, it doesn't look like it will decline from the Fed's lift off, okay? Because the amount of liquidity that will likely put in by the other central banks tend to be more than the liquidity that will be taken back by the Federal Reserves. So I think that's one good thing. But definitely the impact for emerging markets like us could be different from before because as we have seen in the past, we have not received liquidity from the ECB flowing to our part of the world as much as liquidity is coming from the Federal Reserves. On the point on the currency war, I think that the term is a bit too scary. And if you look at what happened in October, when there was a change in expectations and money came back to emerging markets for a short period of time, resulting in currency appreciation of some countries, our neighboring countries in particular. And we saw central bankers and Minister of Finance coming out saying that we would like to see more appreciation, not the other way around, because many emerging markets have large exposure in foreign currency debts. Okay? So I think the policy makers do not think that one-way depreciation is a healthy way, and in any forum, any forum discussions by among Minister of Finance or central bankers, I think we all agree that competitive devaluation will hurt everyone. and particularly now with the potential reversals of capital flows to emerging markets. So I think the perceptions that the perception of currency war is more than the reality. Yes, yeah.
Thank you. And using your analogy, you said Thai economy is a car with good suspension system, but the engine may need overhaul. And you mentioned about the overhauling that we are doing right now. As you are one of the driver of this car right now, what do you see as the major roadblocks ahead or the key challenges that Thailand is facing? And what do we need to do to overcome those challenges to make sure we are going both smoothly and in the right direction?
Well, there are quite a number of reform initiatives. Okay, our role at the Bank of Thailand is to make sure that the suspension is good, and we have a robust suspension system to safeguard stability. But on the other hand, we also help facilitate some of the reform measures, particularly the financial sector reform. If you look at reform initiatives ongoing in Thailand, one problem that we have had in the past is the lack of effective coordination among different agencies, coordinations among government agencies, coordination with the legislature, and coordination with the private sector. So I think that had been major roadblocks for Thailand ongoing. And that will continue to be, I think, a major challenge. How can we ensure that coordination failure is well addressed when driving all this reform initiative forward? I think we have seen better coordination now among different parties because of the public perception that we in need of reform. I think that's very key. Before some parts of the society may feel that or maybe in a denial stage. But I think it's very clear, looking at our exports competitiveness, the private sector is fully aware that we need to cooperate and work towards reform. The government is definitely, particularly with the current economic team, is driving a lot of reform measures and acting as coordinators themselves in working towards a more competitive landscape. The other issues that I would like to highlight, I think most investors will also be concerned that anything that is getting done or getting started during the next year or so, what is the possibility of them continuing over the next few years once Thailand returns to a normal political situation? I think that's a real challenge for our foreign friends and also for the Thai public. But I think that if we get all these reform initiatives started with a firm footing, particularly with a proper legal framework supporting it, my personal view is that it will be quite difficult to backtrack once those have been executed in proper laws. And there have been quite a number of laws that have been enacted or are in the process of getting enacted. For instance, I'm sure you will hear more about the new law on state-owned enterprise reform that will improve governance standards for all state-owned enterprises and also set up a new ownership agencies, which is missing in Thailand, or ownership agency of state-owned enterprises. Once the law is enacted, I think we can move to the next steps, and it will be quite difficult to backtrack. As I mentioned briefly in my speech, the Payment System Act is also something that we have tried to propose for quite some time now. At present, there's no law supervising the overall payment systems. The legal frameworks are very fragmented, providing unlevel playing fields across banks and non-bank service providers. And also there are also certain certain provisions in existing rules and regulations that do not support innovation and do not have a proper principle, internationally accepted principle, like on issues of finality of payments, escrow accounts, and things like that. So once this law is out there, it will set a new stage that we can move forward with infrastructure upgrading. There have been also a number of other laws that have been passed. In the class action law that had been in considerations in the process for more than 10 years. It got passed, I think, earlier this year. There's also a law to facilitate applications of licenses, to set a clear, proper guidelines. And this is the law that the minister touched on briefly this morning, and to eliminate judgment of government officers in the application process, increasing transparency. And this will help a new stage of ease of doing business in Thailand. So it's a matter of us to make sure that we help enforce that the different agencies follow the rules of laws that have been enacted. So I personally would give a lot of emphasis on the legal frameworks, and also some of the transparency, the public buy-in of the major initiatives that we're trying to put in place.
Thank you. Let me come back on the issue on monetary policy. I mean, after the global financial crisis in 2008, the world is facing more of the deflation risk than the inflation risk. And so despite the success of the inflation targeting, I think many critics started to question whether inflation targeting is still relevant or appropriate. What's your view on that for the inflation targeting as a monetary policy anchor in the world where inflation is nowhere to be seen?
Mm-hmm. No, I think that inflation targeting, and I would like to emphasize that the one that we have is flexible inflation targeting, is a proper monetary policy framework for a country like Thailand. As of now, as you pointed out, with low inflation, and indeed it's a low inflation because of the supply side and the collapse of energy prices. So it could make people wonder, why should we continue to target inflation when inflation is too low? The effect of inflation targeting framework is not symmetric. Okay? When inflation is low, with flexible inflation targeting, it shows that we can be accommodative to other objectives of monetary policies. In our case, is to help accommodate recovery of the real economy. But we have to be mindful that if there is a pressure, demand pressure, that will result in high inflation, inflation targeting will still be very relevant in making sure that we can anchor expectation of inflations of the public, and also make sure that monetary policy is credible. As I think people in Thailand, we're very fortunate. We haven't gone through high inflation period, unlike in other countries. If a country has very high inflation, it tends to have destabilizing effects on the economy, on the real economy over medium to long term. So it is important why the central banks need to make sure that the monetary policy framework has a credible framework and give good emphasis on controlling inflation, anchoring inflation. And when you talk about inflation targeting, it's not as simple as having an inflation target and try to hit that target. No. The inflation targeting framework is a framework. It's the whole process of making sure that we conduct monetary policy in a transparent manner. We need to have a communication framework to the public. We have accountability framework between the central bank and the government, agreeing on the range of inflation that we would like to have for the country. So it's the whole process that will help ensure inflation expectation and policy transparency and accountability.
And on that, I think we receive a lot of questions from investors, and this would be difficult for me to ask, but let me ask this. I think many investors are concerned about the independence of the Bank of Thailand and its monetary policy under the current special political circumstances. Do you want to can you please make a few comments on that?
Wondering if there are any incidents that would make investors have such a concern.
No, that's not concern. But that's some concerns on.
So far, I haven't felt at all that the independence of the Bank of Thailand has been compromised, and I don't think anyone at the Bank of Thailand feels that way. If you compare it with what has happened to the Bank of Thailand during the past 5 years. But I think partly because of the low inflationary environment that we have now. So and with the flexible inflation targeting framework, we can be a bit more accommodative than in different scenarios where inflation pressures is pressing. Indeed, when the Monetary Policy Committee, which I also serve as an independent, which I had served as independent member before I assumed my governorship, when we realized that the pace of recovery was not forthcoming, and the government the fiscal stimulus was not forthcoming earlier this year, when we decided to do a preemptive cuts in policy rates, and we had a big deliberations on that, and I think that's also shows the independence of the Monetary Policy Committee, but definitely with no inflationary pressure, no pressure on stability, we can be mindful of other objectives when conducting monetary policy.
Thank you. That's very reassuring, and I guess we will not get any question like that anymore. Okay, let me finish with this question. As an incoming governor, what are your goals that you want to see the Bank of Thailand achieve over your 5-year term? If you want to talk about next term too, it's okay.
Not sure whether that's very kind or unkind of you. The Bank of Thailand is an institution. Okay, I get asked this question a lot, and people say that you just assume your new role. What are the things that you want to achieve? How do you want to change the organization? The Bank of Thailand is an institution, and we have had long-term plans on a number of issues, like the financial sector master plan I mentioned, the capital account liberalization master plan, the payment system plan, and even the Bank of Thailand itself, we have a 5-year business plan. And all these plans have been laid out with good consultations from the industry, the public. Okay. So I think my first step is to ensure that those plans get delivered according to their objectives. Okay. But we also need to be mindful of new challenges out there for the next 3 to 5 years. There are a lot of challenges out there. To me, what is most important is that the Bank of Thailand is on par with the leading central bank of the world in terms of our capability. There might be new capabilities that we need to put in place. For instance, the issues around payment system. We need to be more technology. We have to equip ourselves with better understanding of what's going on with fintech, with technology. We need to be able to have capability to analyze the like of big data that will be generated through the payment system infrastructure that we have. The other aspect that is very important and is very unfortunate, the way the Bank of Thailand Act had been designed, are issues related to financial stability. The Bank of Thailand Act, and the current one, when it got enacted, the bank is basically divided into two functions. One is on monetary policy stability or economic stability. The other one is on financial institutions supervision. Okay. But as we all know, financial stability, which is overlapping between the two, will become even more important over the next 3 to 5 years with excess global liquidity, higher volatility. And indeed, it's not just only financial stability in the mandate of the Bank of Thailand, it's also cross-agency financial stability with the capital market, with the insurance companies. So that's something that I think we need to strengthen in the Bank of Thailand, making sure that our framework and also the rules of operations on matters related to financial stability, making sure that we have tools like the macro-prudential tools on hand, having a good, proper decision-making process, and also reach out with other regulators, making sure that the whole financial stability framework for the overall financial system is put in place.
Seemed like a long list of things to do over the next 5 years.
Yes.
Okay. I think that's pretty much all I have for today. Thank you very much, Dr. Veerathai, for a very interesting and stimulating discussion. On behalf of Stock Exchange of Thailand, Patra Security, Bank of America Merrill Lynch, all of us here today, I'd like to thank you again for joining us today. It was a pleasure having you here with us. Ladies and gentlemen, can we please give him a hand of applause today?